When a company establishes itself and dominates a new sector, an emerging sector, it usually trickles down to every tier and every member of that corporation. With Nvidia minting millionaires at every level of their administrative structure, from CEOs to junior software engineers and possibly supervisors, the growth sector of AI is screaming opportunity, but with what company? Tesla is controversial and it tempers higher from the volatility of noise around Elon being potentially deranged, a power-seeking hedonist, but this could not be further from the truth. He's the only innovator that can see the next bottleneck before it becomes an industrial-wide conversation, securing supply and securing the next iteration of progress for a product. This video is for the Tesla investor who sees the vision beyond pure business to customer EV sales and truly understands or seeks to understand the services as a subscription business and the $1 trillion total addressable market that this venture capitalist like top 10 US company offers. Blue is Waymo and black is Tesla. Waymo started in the Bay Area in 2023 and Tesla a few weeks ago. Who is scaling and expanding faster? Tesla. Blue is Waymo and purple is Tesla. Waymo started in Austin, Texas in March 2025, Tesla in June. Who is scaling faster? Tesla. This red line shows the trajectory of the opportunity for Tesla, straight up, surpassing the competition with ease. James Dalmer, a technological genius software engineer, experiences a combination of Grok AI and FSD with zero problems, enjoying the sunset. Elon echoes that this is just the beginning because the software is rapidly iterating. Dalmer is simply shocked and doesn't submit himself to hyperbole. Tesla deliver on safety as they operate at 10x the safety of a human driver. Waymo appear to just be closing in on the average human driver, not 10x the average human driver. Again, Tesla win. Here is every business. If you want to skip the rest of this video, just watch this part. Everything is a multiple of the autos except semis, which is the same. Still colossal. Autos with FSD 2.1x times bigger. Energy 60% of the autos, still colossal. Robo trucking 43x times bigger than the autos. Cybercabs 101x bigger than the autos. Optimus 1400x bigger than the autos. These are silly numbers, but if Tesla execute and into this emerging dominant sector that could grow to 60% of the S&P index, then this isn't too far off, and these numbers could be very realistic and achievable. Tesla have the best-selling Model Y even in Europe. Adam Jonas, a respected Wall Street analyst for Morgan Stanley, speaks of how people question planes. Now we don't hesitate to curtail across the globe in this cylinder-shaped tin can. Cybercabs will happen and bring down the cost of a mile to the point where it's actually questionable whether you should even own a car. Analysts get it wrong so often. There might be a genuine combination of deception and just misrepresentation of the facts. But what I can see when I see these headlines, it perfectly sums up what the mainstream media can do to your wealth. A decade from now, Bitcoin is more likely to be worth $100 than 100K. That was in 2015. Was this trusted news network and analyst right? No. I don't care what headlines write about the greatest capital allocator and innovator on the planet. Maybe the question should be, why do they hate him? What is it that he is trying to achieve, and what is he disrupting that currently monopolizes their ability to generate wealth and power? Maybe that's the deeper question that we should ask as we see the hate and the increased tension around this individual. Forget the noise around him and actually focus on the products that he's building and how much that's changing the world, improving the world, making the world more efficient. And if you focus on the product, you start to ignore the noise. You start to see the signals of what this company could achieve for humans. This company is my favorite company, and I see so much potential in the small businesses that are Easter eggs in the grand picture that it's trying to create. And if you want to delve a little deeper in this video, go through the technicals, go through some of the signals, go through some of the businesses, go through in particular, the ride-hailing business that's going to dominate over the next 12 months. Like, subscribe, and let's go. Starting off with the technicals and the potential price targets as a result of where the technical breakout is signaling Tesla's move could go to next, I want to just look at the fundamentals that are driving the volume behind why Tesla has really found support at 300. You can see the difference in the change of allocation from these large institutional wealth managers, from Vanguard, BlackRock to JP Morgan Chase. The significant change here is Norges Bank, who are the managers of the sovereign wealth fund for Norway, the biggest sovereign wealth fund on the planet. And they've gone from 0 shares to 37 million shares, which is an incredible move for this extremely efficient and astute allocator of wealth as they're growing the country wealth of Norway. These large investment banks that start to allocate for sovereign wealth funds and institutional players, when they make these types of moves, they are positioning themselves for something they feel is going to be substantial. This weekly Tesla share price change shows the key drivers, and it comes from AJ, the most astute analyst when it comes to analyzing automotive companies. And he can just point out one of the massive changes that's allowed the stock to kind of narrow into this channel before it broke out recently was the change in sentiment around the politics. Elon starting to back away from this American party and starting to be a little bit more focused on the technicals of his SpaceX launches and also the XAI developments and the new iterations of Grok. Then you've got some very positive sentiment coming from the vice president trying to mend the relationship with Elon, hoping things get back to normal. This is all supportive for the share price to continue to move up. This chart summarizes whether a move is realistic and is supported by high volume. The daily trading amount for Tesla is about 28 billion on a 1-year median. But when you see a move up on lower volume and lower trading volume, it can usually lead to that move being reversed. It's not a realistic move when not a lot of players decide that this is actually the new direction that we want the price to go in. Tesla's volume is trading around this median, but on the last recent spike, it actually was trading at $36 billion in terms of trading volume for the move that took it above 330 on Friday. So there is significant volume starting to shift, but again, they're difficult months seasonally because hedge funds are just not at the office. They're not trading. They're not positioning themselves. And so September is usually a very low volume, volatile time, especially at the end of August as well. When I think about where a move is going, I like to look at where the move has come from. So you can see this compression triangle that's been hitting that top resistance line and then also coming into support, creating this asymmetric triangle. But then the volume profile on the right, you can see that those volume shelves usually speak to where a lot of trading volume will happen, where people are happy for the price to stay and they're happy to be involved in the stock at these levels. As soon as you break above 350, you can see that there is no volume profile and it goes straight to 400. And then if it gets past 400, it goes straight up to 450. So these volume profiles show that direction, should the macro support risk assets and the Fed rate funds coming down, this should show that a direction for Tesla could be into that 400 mark before the end of the year. This chart really helped me understand that Tesla is trading in a very narrow channel, and on the monthly, it's just compressing. And when a price of an asset compresses to a certain point, it usually breaks out either up or down, but you know that there's going to be a breakout at some point because the price can't stay in this range. It's being tightly held in a position as the market decides where we're going. And if by the end of this year, seasonally for automotive industries and companies is positive, it looks good for Tesla as well, who are going to, in Q3, outsell their current estimate of deliveries. This 3-week chart shows that Tesla's just broken out of a bull flag and it could target a price of 500 by the end of the year just based on the entry into the bull flag. And you take that same distance from the bottom to the top of the bull flag and then you extrapolate that to see where the price could go. Again, this is all theoretical, and I would say that the price of Tesla being at 500 by the end of the year would be supported by the hype and the excitement around Elon, around cybercabs, around the production of the semis, but it wouldn't be supported by actual earnings. So all of this is speculation when it goes into those ranges of above 400 to 500. This is a story rather than it being fundamentally supported by earnings. This is a really interesting chart that shows just how Tesla can be uncorrelated to crypto. And at the moment, for the last year and a half, it's actually been in line with Bitcoin. But I feel at this point that pair is starting to break out. And I feel that Tesla will outperform for the rest of this year into next year. And it could be significant upside for Tesla and AI as that starts to become the dominant sector over the next few years within the US stock market. This data point came from Joe Badgie, and he says that the future fair value is $844. His personal price target by the end of the year is $580. But this is all based on 10 cities, no driver in Austin, and then also 500 cars being deployed. When that safety drive is removed from the cars and the ride hailing currently operating in Austin, that will signal to the market that FSD 14 is ready for being unsupervised, and that will also signal that they can scale this very quickly. And this valuation model comes from my favorite analyst, Invest Answers, one of the best analysts, and truly does this work just to help retail investors understand where assets could go. He is probably the most influential in terms of my understanding of markets. And I absolutely love how he breaks down the potential stock price reaching 3,482. And it will be based on FSD, robotaxi. It will be based on semi-trucking and also the Megapacks, and then also Optimus over the next 4 years. So by the end of 2029, this is where this price target could be realistically in range. In this next set of data, I just want to look at the macro trends and how the companies that are dominant in the world are all from the US, but they also filter into a category of AI, which just again paints that picture of where the trend is going and how the shifts in different sectors can happen very quickly without really being aware of that change. So you can see the countries and the market caps, and most of these companies are in the US, and most of these companies are tech. This chart shows how there are 3 companies that have got very high PE ratios and they're trading at very extreme multiples, but the potential growth of Tesla and Palantir and what they can earn and generate in future revenue justifies these high PEs, but doesn't support these prices when there is macro downtrends. And this really stuck out to me. The largest US companies by market cap from 1960 to 2025. 1980, it was all oil companies from Exxon to Mobil to Chevron to Shell Oil. And now in 2025, those companies are all AI based. And so these trends are real, and these trends can dominate the growth of the companies that you want to be positioned in. The large institutional positions that are being built and their change in share ownership of Tesla is increasing, not because of the cars, but because they can see that Tesla have managed to solve a ride-hailing autonomous driving solution that could open up the $1 trillion total addressable market that Waymo are not close to being able to penetrate. Waymo, the only other competitor in the autonomous driving solution in terms of their locations around the States. They're too expensive when they scale their LiDAR technology, which is a sensor suite retrofitted to the outside of a Jaguar car. They cannot scale this cheaply the same way that Tesla can with their already existing product, the Model Y, but then also the Cybercab that they're going to start to ramp out next year. And this is what these institutions, Norges Bank, are positioning for. This is what I'm positioning for. This is what I'm invested in this company for, because it's the potential opportunity of autonomous ride hailing and the disruption that comes to transportation as a result of Tesla's scalable solution. So this data set is really useful and interesting from ARK Invest. It shows that currently Waymo's 5th generation in early launch could get the cost of a mile down to $1. These are all extremely ambitious projects for Waymo that aren't currently out in the wild. They've got their Model 3, which could bring the cost of a mile down to 60 cents, which again is going to open up more of a market even for Waymo. And then Waymo's 6th generation can get to 40 cents, but can they scale? The Cybercab that can be scaled $15,000 per vehicle can bring down the cost of a mile to 20 cents. The evidence is in Tesla's ability to scale and manufacture these vehicles quickly, cheaply, and with operating gross margins that are going to be positive and lead to free cash flow. Waymo lose money on every vehicle, and they have to charge high dollar per mile amounts because they just can't afford to bring down the price too much. But they will have to if they're going to be able to compete with Tesla, who have an already existing solution that can bring that cost of a mile down to under $1. This just broadens and opens up the market even more. Next data set is just showing how Waymo's fully autonomous vehicles are actually starting to take over the ride-hailing services within San Francisco. Uber's trending down, their market share is trending lower. Lyft is trending lower. Waymo is trending higher. This signals that people want to be in autonomous vehicles. They want to be in a car that doesn't have a driver, with all of the spontaneity that comes with someone who drives, who you don't know. So when Tesla starts to operate in these cities where Waymo already exists, it shows that they can start to undercut Waymo's prices, but the market already wants to be in autonomous vehicles just based on this data point. This comparison is really good. It shows robotaxi, Uber, Waymo, and Lyft. And I'm just going to go straight to the cost. These same journeys, $3.84 for the robotaxi, $9.93 for the Uber, $21.54 for the Waymo, and $10.85 for the Lyft. These are 1.36 mile routes, and Tesla's robotaxi solution is already so much cheaper than all the other existing opportunities. But still, people are still willing to pay for Waymo because they don't mind having an expensive ride as long as it's without a driver, which signals where the market wants to go and where it will probably go. Just like Blockbuster to Netflix, just like a Nokia flip phone to an iPhone, just like the bookstore of Amazon to the AWS cloud storage software. That's exactly where the market wants to go. This is the most important of all of the charts that I've managed to see when it comes to ride hailing in the addressable market. And it just shows that as you bring the dollar amount down, you open up larger amounts of addressable Western markets. So when you get the cost to $1, you open up $1 trillion addressable market. When you get the cost down to 50 cents, you open a $2.4 trillion market. When you get the cost of a mile down to under 50 cents, you open up a $1.9 trillion market. And then when you get the cost of a mile down to 20 cents, which is what Tesla are aiming for, you open up the market to 5 trillion, which is extremely high margin service as a subscription revenue earnings that will truly take Tesla's stock into 2026, 27, 28 to higher levels. So could it be relevant? The only thing I really want to say at this point, because I'm not sure how many people get to this point in the video, but it's just more of a reflection on how fully self-driving can actually really save lives. And this final post really stuck with me. It made me think about just the autonomy that opens up to people who can't access a car and the amount of lives that can be saved when you have this type of sophisticated solution that Tesla's fully self-driving version 13 offers at the moment, but then also when it starts to iterate and bring out more software updates for version 14 and then for version 15, it will be so sophisticated that the accident rate will just reduce so much, so dramatically. Full self-driving supervised miles are currently 4,847,785,994. 1,793 crashes prevented, 59 lives saved. This, as it scales up, can lead to step changes that can lead to hundreds of thousands to millions of lives being saved every year from just nonsensical accidents that come from the human error of being in a car. Therefore, I feel it's got real potential, and the market seems to understand this, and that's where I believe the ride-hailing transportation disruption is going to be in just the saving of lives, the efficiency, the cost of a mile, and then the autonomy and the access that people can have to getting around a lot easier, a lot more efficient. And then also within the cities, the way that the cities will look as you start to create more green zones, as you don't need as many cars in car parks, and the dead miles will be changed as packages can be delivered in the robotaxis as they're not being used for people and passengers. So it just makes a whole city more efficient. So this final picture is Jay Powell as he started to pivot towards making rate cuts. This is an Ibiza meme of this guy with a ridiculous haircut. But then Jay Powell basically made a pivot that sent the markets roaring. And then they've also returned to those levels before he made this pivot. But this pivot signals that potentially for the rest of this year, risk is on. Rate cuts are going to happen. And as the rates come down, money is just going to enter into risk assets. And that's in a seasonality for automotive industries, which are really good. And this could be good for the rest of the year. I think September is going to be very rocky, very volatile, with some extremely high spikes on the VIX, which is the volatility index, which is going to mean that we're going to have some opportunities to buy. But then October, November, and December could be extremely exciting. Who knows? Either way, hope you got some value from this video. Thank you very much. See you in the next one. Bye.